Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, XL Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moinian Group.
Hello, my name is Michael Stoller. In this difficult recession, there is still money for real estate and commercial loans. But the big question is, who is providing that? So I have assembled 4 leading banking executives, that's a nice word to say about them, today to discuss what's happening in the state of the market. My guests today include Stuart LeBeau, President and CEO of Community National Bank, Robert Familant, Treasurer and CEO of Progressive Credit Union, Joseph Murphy Jr., President and CEO of Country Bank, and last but not least, the newest kid on the block, Joe Hopster, Executive Vice President and Chief Credit Officer of Herald National Bank. So since you are the newest kid, the newest bank in town, what are you doing?
Well, we started in late November, as you know. Okay, so we've only been open for 5 months, but we booked about $60 million in loans so far, and we have you know, a list of about over 200 million in lines that we're working on. Those will not all close, but we'll say 100 million of those will close. So what we've been looking at is real estate loans in New York City and the 5 boroughs, mostly multifamily apartments and professional buildings. But the other thing we do is we think there's a lot of opportunities for our investors, our customers, and we give them real estate lines of credit. We find someone who's got a lot of equity in a building, maybe no leverage on it whatsoever, but they want a line of credit to go out and take advantage of the opportunity. So we will lend them in a line $3 to $5 million at, frankly, you know, 4 to 5% interest. It floats up and down.
How long is this line? For a year, 2 years?
No, usually 2 years. So some of them are only for a year, but no more than 2 years.
Will you charge a fee for this?
We've charged a small fee. What we're really into, though, is we're a relationship bank. We've been focusing on that, and we want to get that customer's deposits and all of his, as much as we can of their assets and whatever. But you know, we're a small bank, so these people are frankly the New York families and real estate families, and they're going to work with us one property at a time.
No question. Now, you owned a bank in New Jersey. You sold that. You started another bank. Tell me a little bit about your bank.
Well, Community National Bank is 4 years old now. We've just opened up our 7th location in Long Island. We're in Nassau and Suffolk, and we're about $400 million in assets right now. And in 2008, we put on about $100 million in commercial loans. And we're really focusing on, as we were saying, is relationships, building those relationship banking customers. And so we're doing everything from commercial real estate to corporate loans to SBA loans. And what we're seeing is there's a terrific opportunity for us because the larger institutions, because they're so involved in the issues of the day and have become embroiled in whether it's subprime or other problem assets have really stepped back from the lending side and the relationship side. And it creates an opportunity for us to get involved with customers that typically had always stayed with the larger institutions. So we're seeing large deposit balances and large commercial relationships coming to us.
So you, the 91-year-old bank, credit union, correct?
It's 91 years old, yes.
91, I have it right. Celebrating your 91st year, AKA the king of taxis. What are you doing these days?
Well, our main niche has been and remains medallion taxi loans in New York City, Chicago, Boston, Philadelphia, and Newark. But in addition to that, our medallion owners, who are very entrepreneurial, have brought us into a lot of other commercial lending venues. We've done laundromats, we've done car washes, we do small commercial properties.
Diners?
We do diners, we still do diners. And as they grow and as they mature, we've grown and matured with them. We've also seen, as you were saying, more deals coming our way the last 18 months, things we had never seen before, properties that normally would have gone to much larger banks at much lower rates than we're willing to offer, aren't finding a home. And so we get phone calls all the time now from people looking for things that we weren't necessarily advertising or marketing, but they're well secured and there's significant cash flow, and so we're taking advantage of those opportunities.
And you, Joe?
We're excited about the market. I think there's great opportunities for grassroots type of lenders like Country Bank. Our bank has been in this market for about 10 years now. And
you're what, a $500 million bank?
We're a $500 million, and we're invested purely in commercial real estate deals, all right here in Manhattan and the boroughs, except for Staten Island, of course. That's we don't count.
Why,
that.
is it something criminal?
There's something about the river. And the thing, I don't.
There's a
I
bridge,
don't
you know. It's Verrazano. You go over there. There used to be a ferry.
Yeah,
you can
exactly,
do that.
but. Look,
I can understand somebody who used to say
really
the Bronx,
well
maybe, but now you're adverse to Staten Island.
Well, actually, it was only until about 5 years ago I used to think we needed a passport to get over to Brooklyn. But as you know, the Brooklyn market has been just booming for the last 5 or 10 years, and so we've been very happy to be in a number of the different neighborhoods over there.
But what kind of, you say you're in a, all you do is real estate loans. I mean, over here, the three other gentlemen are diverse loans, commerce and industry, medallions, a variety. What type of loans do you do? I mean,
well, you know, when I say only
bodegas,
real estate,
bars, I mean,
we pretty much do it all, but generally any kind of asset that we're dealing with is never taller than 5 stories tall. And it's all commercial. We don't do any kind of single-family stuff. We do a lot of multifamily. We do retail. We'll do office condos. Not that we have a lot of that stuff. We've got, you know, a couple of small motels or limited service type of hotels that we're very, very happy with. But primarily we do a lot of multifamily. We've done a fair amount of transitional stuff over the last several years where we've been able to find a little niche in the market for developers that are buying assets for $1 million, $2 million, doing a little fixer-upper, and then renting out the units once they've finished whatever it is that they're doing. We think it's terrific simply because, you know, the last 5 years has been irrational exuberance in the real estate market. Anybody that's been in this market for longer than 5 years can recognizes that things were crazy. I mean, when I'm competing with people that are putting out commercial loans at 5%, 5.5%, 6%, when cap rates are at 5, 5.5%, 6%, I can't make any sense out of that.
Okay, but you know, Joe, today there are banks who continue to put out money at 5, 5.25, like New York Community Bank. They want to put out $5 billion. They want to put $5 billion.
Two wrongs don't make a right.
I mean, Joe Harvston may be with a new bank, but you've been in lending for 30 years. I mean, so you've seen that. I mean, how do you look at the market? Because values are dropping. You know, this is a big question. You know.
Can I just add one,
Sure.
one just general comment, and that's that I think we've seen a major herd mentality, you know, over the last 5 years, and everybody's been running after all these deals. I think that the community banks and the smaller banks that have real skin in the game, you know, that are highly regulated, much more so than the money center banks, found themselves playing by the same rules we played by 5 years ago, 10 years ago, and 15 years ago. And as a result, we're still here, and we're still lending, and we're still happy to participate in the market.
But my big question that I just brought up is, you know, you said you like Brooklyn, and that values are dropping. I did a show in Brooklyn last week, and basically all the 4 developers, from small to, as I said, he used to be the 800-pound gorilla, but Toll Brothers is only the 500-pound gorilla today. Every one of them said that prices in Brooklyn for condos are down by 20%. At least, they're down by 20–25%. So how do you make a loan that you're comfortable? You know, the question is, Robert said before, value. What's value?
Well, the fractured condo market is a real mess, and many of the bankers are just avoiding them. I'm not so sure there is a market for those today because they don't know where the bottom is, and it's really crashed. So it's hard for them to get comps. And Toll Brothers reduced that property. When they had one property, they were selling units
25% in
$1,300,000, and they reduced them to $875,000, and that was a few months ago. So, but that's an indication of what was happening in Brooklyn. This was all in Williamsburg, I believe. So it's that's a real tough market.
But we're still seeing that also in Long Island City today. I mean,
those are larger projects. We do a lot of smaller stuff, and it doesn't take much for a small piece of property to not only lose its value, but for the cash flow to get upside down, which is, I think, a more dangerous circumstance. For example, we have a 9-unit building on St. Nicholas Avenue on 147th Street. 2 apartments are vacant, and that's the difference between being profitable and not being profitable, and that's how easy it can become. Someone loses a job, someone moves out of town to follow a job. It's very difficult to find value.
I think you're bringing a very good point. There was an article in the Times today, and saying that certain people can't pay their rent. The larger situation is even worse than that. Many of the landlords who have been on my shows or on my panels have basically said they will do anything to retain a tenant today. In the multifamily. I mean, people like Lloyd Goldman said, I'll give the broker a month to 2 months, and I'll cut the rent by 10% because I don't want 40 vacant apartments in my buildings.
Well, it's all about cash flow, and the reality is that it's a vicious cycle. As you have vacancies, et cetera, it's harder and harder to create that cash flow. I mean, one of the things that we do and in our multifamily portfolio is we're looking at vacancy rates at substantially higher than they've been in 10 years. And so when we're underwriting, we're taking that into account. One of the issues, again, is we're looking for strong landlords, owners, as well as personal guarantees. But there's still money out there to be lent.
No, I think there's money to be out there. There's a study that came out about a week and a half ago about the leasing market in Long Island. It was horrendous the first quarter. It's completely down. I mean, the retail market. I mean, we had the show the week before when I had Manny Stern on. It was talking about, hey, New Jersey retail is terrible. New York City retail is good because New York City is basically under-retailed in certain markets. Urban markets are perfect places. So how do you feel comfortable when you do a retail loan? Joe? Robert? Stuart?
The best information you have on any given day is the best information you have on that day. So you do your appraisal, you do your analysis. 3 years ago, we would do an appraisal and the borrower would come and say, oh my gosh, what are you kidding? That's the appraisal. It's already up 5% since the day you did that appraisal. And maybe it was. Maybe it was back then. Today, we're looking at it from a much more cautious point of view. I think appraisers, if you use a good appraiser, are also taking a much more cautious approach. 3 years ago, people came in with vacant buildings and rents that they were going to charge, and that cash flow was based on those projected rents. You won't accept that today. Right. So everyone is being much more cautious, everyone is being much more diligent, and the day the applicant comes in and the week that you underwrite that loan, That's the best value that you have, so you have to be careful.
But you know what I said at the start of the program is that all four of you are continuing to lend. I mean, you're in business, you're there. Would you say that you've changed your underwriting standards over the last year?
I would say that we've definitely changed our underwriting standards, and I think it's a function of the market. And the reality is that you lost all of the capital market lenders, and which was a big part of the market, and as a result, they were kind of on the top of the the capital stack or whatever you want to call it, and we found that the regional banks and the super regionals and then the community banks and so forth, they were feeding further and further down the food chain over the last 5 years. Now, in the absence of this capital markets, everybody's kind of moved further up the food chain. So the selection of deals that we have to look at is much, much better.
Which is what Robert was saying before. Right. Now, there are lenders, I use this as a very good example, CIBC. The Canadian banks are all strong. They were the strongest banks. But if CIBC would do a real estate loan today, their prices make you look cheap. I mean, they want 2 points in origination fee, they want 2 points out when the loan is paid off, and they want an 8% rate.
And that's also a function of the size of deal that they're working on. I mean, they don't...
No, this is even on a $10 million deal. It's not to the level that you would think.
Well, again, we're talking community banks here, so, the appetite for those larger deals, the 10 million plus deals, and the population of available lenders, because the capital markets groups are gone, has shrunk to such a level that they can command those kind of rates. But in the marketplace we're talking about, which is probably the $1 to $7 or $8 million marketplace, there's a lot more opportunity. But I would say that in general, most of us probably haven't changed our underwriting standards that much, in that we still require personal guarantees, we still require good cash flow and relatively low LTVs, and you're always looking at second and third ways out of deals, as opposed to putting deals together that are going to be sold as part of a mortgage-backed security pool down the road, and now those deals that would have normally gone to those mortgage-backed security populations are coming down to us. But we're still using the same underwriting criteria we used before.
Michael, what's going to happen? Because we've got $1.3 trillion of rollovers coming up in the next 5 years, and
it's even shorter than that.
Okay, but it's a lot of money, and the community banks can't absorb it. And frankly, a lot of those loans could be underwater. It's going to be a tough problem.
I mean, we were talking a little bit when we did the show in New Jersey, and Emmanuel Stern, who owns a number of hotels in New Jersey and a couple of hotels in New York, basically said, my occupancy is okay, but my rate is down by 50% in the hotel market. So that's, something, when you mentioned that you're doing hotels, that's an unusual...
I don't know, I didn't say I'm doing new hotels or I'm booking hotel loans today. We've done hotel loans. We have a couple on our books as of now, limited service type of things with strong operators, number of properties, and also, not the high-end stuff.
No, I understand, but I mean, I remember Robert once did a hotel in Rochester.
Rochester, New York.
You still remember taking back the keys?
I'll never go back there.
but it was Rochester. It was,
right.
it was a different case.
You probably have a hotel loan where the owner is very strong.
You're not going to believe this. You mentioned Rochester, New York. Somehow I got into a hotel deal up in Ithaca, and it was it's a flagged limited service economy type of place. And it was a terrific deal. It's performed for several years. I had a great rate, like 9% on the deal. You know something? A local New York City bank just took me out of that deal. And they took me out at 300 basis points less than what I've been charging for I was amazed.
They did it in the
And,
sixes.
So,
in
so
the
what-
sixes.
You know, so here's my question.
It was a stabilized
Okay,
deal, and they were doing well.
What
and
is,
so
you
forth,
know,
but,
you know,
it's like,
for my
wow.
viewers and the people watching us on the internet, what's your flavor of the month? What type of loans, you know, that they should go to Herald Bank? You know, if somebody said, I want to go to Joe Hopster or one of the bankers at Herald, what are the loans that your credit committee is going to approve?
Our credit committee is going to approve 3 types of loans. And when I talked a little bit about the multifamily loans with LTVs about 70% and DSC ratios of 1.3, 1.4 times, they'll sail right through. And the other loan is a commercial loan to a small business where we're lending against the receivables on a formula basis, which we track every month, and we have the guarantees of the owners. And what we do at Herald Bank, we've recruited a lot of teams from different banks where they've known this customer for some time, and their knowledge of the customer and the monitoring that we're going to do, we bring those right in. And the other thing is, the other thing we'd like to do is the individuals behind these companies, and we help them with their global wealth management and what they're doing with their personal lives. So there's 3 different types of loans we do. The latter loans are usually secured by liquid assets or maybe even a mortgage on a property.
Joe, today, what do you like doing?
I mean, I think cash flow is really the name of the game. And, I mean, we love cash flow.
You know,
We're
we
looking
were
at,
joking before that you've done a lot of successful bars.
that's right.
Would you continue doing bars in this environment?
I think so. I mean, we have a clientele that we know well. They continue to do things. They continue to look at opportunities, open up locations, and we're happy to work with them.
What about restaurants?
Restaurants is, I'd say, a little bit more dicey, but we are involved with a couple of quality operators that may be changing sites, things of that nature, not necessarily expanding, but relocating. Cash flow is really what it's all about, and I mean, it's an opportunity to make those types of loans. It's something that from a risk weighting standpoint at a bank is a very good thing. We prefer multifamily type of stuff, owner occupied, cash flowing, types of commercial real estate. Cash flow, cash flow, cash flow.
Robert.
Well, in addition to our niche medallions, we like small businesses where people get up every morning, go to work, we know they're there, we know where to find them, they've got some expertise in the business that they're operating. But if you talk about what's the flavor of the month, what isn't the flavor of the month that people used to be able to do is nobody's getting any cash out. People walk in the door and say, well, I'd like to take a little, operating capital. That used to be the catch-all for some money out. Nobody. We're not giving anybody any money out.
I think that's a great comment because, in one of my other life, I'm with a company who's a private debt service, debt fund. And when I look at a loan, every Tuesday we have a meeting with all the loans. And when somebody's saying, I want to take money out, I say no. I mean, it's not really that. I mean, in this market, I'm not willing to give away money. I want, if they have a reason to use the building or they're going to do it for some other purpose, fine. But don't tell me I'm taking money out of
And we're seeing deals that are that are maturing at some of these larger banks, and the banks are throwing them out. And they were paying a lesser rate. They come to us because we're lending, and we're happy to make that loan, but we're not giving them any cash out. We'll restructure their existing debt, probably at a higher rate. We don't even want them to we don't even want to throw in the closing costs. They should be able to manage that on their own if they're a substantial borrower.
Stuart.
Yeah, I mean, again, I agree with what everyone said. It's all about cash flow. The reality is that in the last month, I probably closed about $20 million worth of commercial deals. Most of it C&I with the real estate as collateral and relationships. We're bringing deposits, entire relationships, lines of credit secured by the building. Again, it's the kind of business that community banks are in, and the kind of business that grows relationships.
It's interesting. Borrowers come to all of us and they say, LIBOR is 1%, prime is 3.5%. what are you charging me? And, you know, so what do you charge? I mean, you know, this was a conversation I had with a potential client of ours before, you know, and we told them that we have to get 4%. That's our LIBOR floor, you know, if we're going to
A lot of the banks have, especially small banks like ourselves, have floor rates because, frankly, at 3 1/4, it doesn't really pay.
Right. We're at about prime plus 1.5, but a floor of a minimum of 5. And that's typically, you know, the floor rate, and it could be a little higher depending on the deal.
So that's on that's a commerce and industry loan. What about a real estate type of loan?
Real estate, we're basically at 6.5%, 5-year fixed. And
with any amortization?
With amortization and a floor rate on that as well.
We also have a floor rate closer to 8. Closer to 8. And when people come in and they tell me what LIBOR is and what prime is, and they'd like to, of course now everybody would like to have a floating rate that's just above prime or just above LIBOR. That's not who we are. That's not the kind of loan that we make. And we explain that, that our cost of funds is higher than others. And in order for us to be able to process the loan, this is what we're going to need to charge. But we'll process the loan. They've been other places, and it's not getting processed, and that's why they've come to our door, and that's why we finish the transaction for them. Because we're open for business, we want to do business.
Joe,
excuse me, sir. And we're going to get back to you in a week and let you know that we can do the deal,
or that we can't.
Correct.
We're not going to, but we're not going to extend the time. If we can't, we'll get back to you in a day. Usually, we don't want people to have false hopes. If this works for us, or if it's got some traction, we know it right away. I'm sure we all do.
I think those are excellent points, and I mean, in our case, we can perform, we deliver, we get it done, we do what we say we're going to do. You know, you're talking to the president of the bank, you're talking to a senior executive. You know, obviously, we don't have any bureaucracy.
That's why I have all the executives here.
I like to say that we've got a flat organizational structure.
And are most of yours referrals from existing customers? Because that's
absolutely,
what we get.
absolutely.
We get referrals from people we know.
And what's important is relationships, and two-way relationships. Not just us putting the money out, but us getting the money in. And just a comment would be that for the last 5 years. No pointing, okay. No
pointing. The problem is, to having 4 individuals who are still in the business, it's tough to talk for 30 minutes, and we don't have any more time. But I'd like to thank Stu Lubo, Robert Famelin, Joe Murphy, and Joe Hofstad. Cut off at the knees. No more knees. See you next week.
Thank you.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, KILROY Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, XL Realty Advisors, First American Title Insurance Company of New York, FirstService Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moinian Group.